Hello and welcome to Livewire Markets. My name is Chris Conway. We've got something special for you today. I'm joined by Jamie Hanna, Russell Chesler and Cameron McCormack from VanEck. We're going to be discussing the VanEck Australian Long-Short Complex ETF, trading under the ticker ALFA or Alpha as it's otherwise known. Now gents, I must confess, in the busy world of ETFs, this one really stands out to me. I generally love long-short strategies, and when it was launched, I was intrigued by it. So Jamie, I just wanted to come to you first, set the scene for us a little bit. Talk to me about Alpha from an innovation perspective and what it means in terms of the ETF landscape.
Look, Alpha is really an innovation in Australia, I think. It's bringing an active, fundamental, systematic strategy to the ASX. Investors can obviously buy through their broker like they would a normal ETF. But what it really is an Australian equity long-short fund, but it's utilising some of the world's most advanced computing power. It's using regenerative learning, and it's basically picking up signals that are otherwise not part of the normal metrics. So what we've done as a team, we've used some of our knowledge that we have gained over the years in smart beta, and we've then combined that with some of the traditional alpha, and we've really created this strategy which is systematic alpha.
Russell, Jamie touched on it just there. VanEck has done some really cool stuff in the past in terms of passive ETFs and smart beta. How are they shaping and rolled into the Alpha product?
I think that's a really good point to start on. If you look at VanEck's history, we've really been very innovative when it comes to product design. Certainly in the smart beta space, we're really proud to be the leader in smart beta in Australia. We launched our first smart beta ETF back in 2014. That was a MVW, our equal weight ETF. And then shortly afterwards, we launched our Quality Global ETF. And that now has around 8 billion in assets, and it's the largest in the market. Now, when we think of market cap ETFs, like those that track the ASX 200, there's really no product development work involved. You simply license the index and replicate it. But when it comes to smart beta, it's a completely different story. It's a lot more complicated. In developing a smart beta strategy, you really need deep quant experience. You need to design the strategy. You need to test the strategy. At the end of the day, when it comes to smart beta, there are countless fundamentals, factors, and constraints that can be put into the index to make it up. And you really need to get that balance right. And in order to do that, you do need rigor and experience. And that's why, if you look at our investment team is very strong on the quant side of things. I'm an actuary by background. Cameron has an actuarial background as well. And Jamie has many years of hands-on investing. So when it came to developing a systematic alpha strategy, which we, as you said, called ALFA, Alpha, we really just built on what we'd already done.
Nice introduction to the product, Russell. We'll change gears a little bit. Cam, I'll come to you. We're going to focus on the environment that Alpha is operating in. So interesting times that we're living in, but just talk to me about the state of play for Australian equities at the moment.
Yeah, we all know that obviously Australian equities and even global equities have run quite hard over the last 12 months. The ASX 200 is up just shy of 13%. What's really interesting is that if you look at where valuations are at, we all know that they're quite expensive, particularly on the large cap spectrum. We know that mid caps and small caps have started to really come to the fore recently. And really at the moment is, okay, well, where are the next growth drivers? And we know that obviously looking at fundamentals is a key focus, but with valuations expensive, it really pays to be quite selective in the space. And that's, I guess, really leads into why we think that taking a long-short approach makes sense in the Australian market in particular.
Yeah, so talk to me more about that long-short. I guess the question is why. You sort of touched on it there, but just take us a bit deeper.
Yeah, so if you think about, I guess, Australian equities at the moment, and if you look at from a sector perspective, the dispersion in returns over the last 12 months is almost 50%. So you saw utilities have been best performer, whereas on the downside, you've seen healthcare stocks, in particular CSL's been under a number of, I guess, headwinds. So, clearly there's a lot of opportunities there, both from a longs perspective and from a shorts perspective. And when you think about the Australian equities market as well, in particular small caps, there's a lot of, I guess you consider them, junk names. So that creates opportunities on the short side as well. So taking a systematic approach to find signals that suggests maybe that company is going to underperform, we think makes sense in the Australian market and taking that long-short approach.
Russell, talk to me, you talked about the horsepower behind the product earlier. How does Alpha stay ahead of the curve? Because obviously things are changing all the time.
If you look at the range of different systematic approaches, some of them are based on sentiment, some of them are based, you have ones which are based on factors, fundamentals. But we all know those all have their shortcomings. So when developing alpha, we wanted to go as broad as possible. We wanted to be really comprehensive. We wanted to have a strategy that adapted to different markets. So we wanted to include multiple different disciplines to really get a very broad view of what's going on in the market. So in essence, alpha draws on 3 strategy or signal baskets. So the first one is company and fundamental signals. Then we've got pair trading and technicals. And lastly, we've got macro signals. Now, our quant platform runs thousands of these signals. It's running it all the time, and it's testing the efficacy of these signals, trying to determine which of these signals is going to result in the best possible risk return, result in the best possible amount of alpha. Importantly, it uses a huge amount of computing power, as you mentioned, and at the end of the day, it's updating the information constantly. And really, that's how we stay ahead of the curve, in that it can really adapt instantly or very quickly to changes in the market environment.
Gents, we dived right in there. I just want to take a bit of a step back and a little bit more about the nuts and bolts of the strategy. Jamie, I'll come to you. Just take us through how long short works on the ground.
Yeah, so long short is really designed to take advantage of ups and downs in the market. So from one side, it actually goes and buys a lot of stocks, and then it will sell some stocks at the same time. So what we actually target is what's called a 130-30. So if I break that down, we will buy $130 worth of stock if we had $100. So if you gave the fund $100, it would go and buy $130 worth of stock. And then on the opposite side of that, it would then sell $30 worth of stock. Now, that will then leave the fund roughly at the $100 that it came with. Now, how does that actually work in practice? So on the long side, that's quite easy. We can just go and spend $130 worth of purchases when we buy the shares. But on the short side, you actually have to go and borrow the shares before you can sell them. You can't sell something you don't own. So we have a securities lending arrangement. We go out and we borrow stock. Once we've borrowed it, we can then sell it in the market. So it's designed to take advantage of upswings in the market while protecting on the downside, or actually trying to gain extra performance on the downside as well. So this whole thing works together so that the fund is technically leveraged up to 130% on the buys, but it's offset by the sells, which are the short sales, which bring back down the performance back to leave it roughly flat around 100.
Cam, we've talked a little bit or heard a little bit about the quantitative screens and again, the horsepower and the energy that goes into that. Talk to me about how those screens arrive at the final constituents that make it into the portfolio.
There's really 3 key buckets we look at. So the first one's looking at changes in company fundamentals and also industry fundamentals. Now, this is really important because if you think about smart beta investing, quality investing, again, it's looking at 3 company fundamentals as a persistent driver hopefully persistent driver of outperformance over the long term. Now, it goes beyond that. So we're looking at, ranges of headline metrics. So for example, companies with maybe high return on equity. But it's also looking at industry-specific fundamentals. So for example, if we're looking at, say, the Australian retailers, JB Hi, for example, maybe looking at changes in inventory levels to ascertain demand for their products. If you're looking at, say, Qantas and Virgin, it could be looking at changes in passenger levels going through terminals to, again, ascertain demand. So it really does go down to that granular level, and it's looking at, again, the extensive computing power that's at play. So that's the first component. Yep. The second component is looking at technicals and pair trading. So essentially what that means is it's looking at a range of measures in terms of tracking the change in price performance as a gauge for whether maybe there's potential further upside or potential downside for a particular stock, or if there's, say, a divergence between, we know financials and materials typically are inversely correlated relative to where the ASX 200 is. So it's trying to really build on that component. The third component that brings it together is looking at changes in macroeconomic signals. So we're looking at changes in inflation, changes in economic growth, but it's also going beyond that. So looking at changes in, say, services inflation, how that's going, changes in goods inflation. Now, why this is important is because we know that certain asset classes outperform in certain markets. So for example, if we're in a low growth, low inflation environment, typically quality companies outperform. If we're in a high growth, high inflation environment, small caps and mid caps tend to outperform. So it's really trying to bring quantitative signals, technical changes in technical signals, and then macroeconomic signals to find companies that have the highest propensity for potential outperformance for longs, and then on the flip side for the shorts.
So Cam, those three buckets lead to a score for each company, right?
That's right.
And then Russell, how do you use those scores to implement the portfolio?
Well, the scores really form the foundation of how we actually build the portfolio. So each of the 300 companies in the ASX is ranked. So they're ranked from 1 to 300. Those with the highest scores form the basis of our longs. Those with the weakest or the lowest scores form the basis of our shorts. So if we look generally at the portfolio, typically we would hold between 15 and 50 longs and 0 to 25 shorts. Currently, for the audience, we're holding 18 longs and we're holding 15 shorts. And that's where we believe there's the best opportunities in the market.
Russell, I'll stay with you. Talk to me about the risk management framework that sits over the portfolio.
So Alpha, as we've said, it's agnostic, it's unconstrained. So in terms of risk management, our risk constraints are quite wide. We do have risk constraints, particularly in respect of individual securities. So we have maximum we can invest in individual securities, as well as across specific sectors. And of course, being a long short, we do have a sophisticated stop-loss framework in respect to the shorts.
Jamie, I'll come to you now. Performance. Everyone's concerned about performance these days. How's it been since inception?
Yeah, so we launched the fund in January this year. To the end of October, the fund was up 12.3%. If we compare that against the ASX 200 accumulation index, it was up around 8.64. So it's 3.5% outperformance since we launched it, which is good. If we actually break it down into what's happened this year, we've had a lot going on this year. We've had all the rollout of all the tariffs. It's resulted in trade wars, trade negotiations, and we've seen increased defence spending across the world, as well as critical mineral plays in Australia. So there's been a lot of volatility globally, but the fund's been able to manage through that. If we think about some of the sectors that have really done well, we've been consistently overweight gold mining companies in Australia in the fund. And realistically, if you look at that, it's played out pretty well for us because the price of gold has rallied extremely hard. And as a result, the underlying gold mining companies that sell the gold have been able to increase their bottom line profits because they're selling something for a higher price when their underlying costs are fairly much unchanged. And the other sectors that have really contributed as well, we've been overweight industrials and consumer discretionary, but we've been quite selective in the names there. And I think that's really played out. So we've really focused on companies that have had the strongest signals within industrials and consumer discretionary. But it's really not just taking those individual companies, it's comparing them to their peers in that area and identifying the ones that have the best opportunity for success. So between those three sectors, it's been some of the strongest performing areas within the fund since launch.
Jamie, question without notice, and no worries if you don't know the numbers off the top of your head, but that outperformance, has most of it been driven by the shorts or the longs?
Most of it's been driven by the longs.
Talked about sectors there, so Cam, I'll come to you. What are some of the factors that have led to the conviction in the areas where the alpha has been generated?
Yeah, so there's a few key areas. I think the first one from a company fundamentals perspective is companies that have shown an improvement, quite a stark improvement in free cash flow margins. There's been a key signal that's come through, and even companies that have elevated free cash flow margins, so clearly like gold miners have been a key beneficiary of that trend. Also a range of retailers and also in the industrial space. The second component from a macro standpoint has been certainly an improvement in the Australian economy that we've seen recently. GDP growth has started to improve. Retail sales have also started to improve from that standpoint. And that's been a key signal for, again, taking those long positions. Now, on the short side, what's been interesting is that a deterioration in free cash flow has been a key signal for taking short positions. And you can see that there's been a few names that have really ramped up CapEx, but at the same time, also, increased leverage. And that's been a signal for potentially taking a short position in that side as well.
Jamie, Cam just gave us some of the factors. What are some of the stocks where those factors have played out? What are some examples of longs and shorts?
I'll give you Technology One. It was really a standout performer in the first half of this year. If we look into it, Technology One is actually a company that produces software for universities and local councils in Australia. And they've really entrenched that software within the university and local council government area, across Australia. And if you think about universities, they can actually provide software that takes you from the application process, applying to get into university, right through everything through your university study, right through to your graduation. So they've really focused on that. And they've been able to increase their first half profit by 33%. They've increased their cash flow margins. So if we look at actually the signals behind that we were talking about, one, obviously 33% increase, but it's because what it's done is it's freed up their cash flow at the same time as also increasing sales. What you then couple that with is some of the momentum that drives that stock. And if you compare it to their peers, they've also got very low debt. So if you couple all these things together, it was a standout performer for us in the first half of the year.
Thanks, Jamie. Cam, I'll come to you. Talk to me about CSL on the short side.
Yeah, CSL's been in the press obviously for quite a period this year. It's actually been quite a good short for us. We entered the position back in July, and since then we've really seen two key, drops in the share price. We saw that post the August earnings season. That was their biggest drop since 1999. Now, a key reason why we took that short position was we'd seen a persistent deterioration in enterprise value relative to their cash flow and also sales growth. Now, in particular, this might on the surface been seen as, cheap, but when you look at their headline growth, particularly over the last few years and on a forward-looking basis, it's quite benign. And we know that the company's had challenges in terms of trying to spin off its vaccine department. And then we've also seen, challenges more broadly speaking in terms of their R&D investment being again translated into sales growth. So there's been a range of things for why we've taken a short position in CSL and why it has worked for us as well.
Russell, I'll come to you now. Talk to me about another long position that's done well.
Well, Eagers Automotive really is a position that's done incredibly well. We entered the position in July, and since then it's actually doubled in price. It's our top performing stock. And there really the key signal, it was a company fundamental signal, but it was really growth in earnings. And over the years, its earnings has also become more stable. So where we really saw the share price get momentum is after their half-year results announcement, where we saw revenue up 19% to $6.5 billion, projected to be 13 billion for the year and 50% up over the last 2 years. They've really also benefited in terms of a change in sentiment, and that's really been around their strategic partnerships with BYD as well as Mitsubishi. And then just last month, they actually spent $1 billion buying 65% of Canada One. So they've made their first foray offshore. I think what stands out, they actually distribute 31% of electric vehicles in Australia, and that's really a sector that's growing quite quickly. So, if we just look forward in terms of what we see on the stock, we do believe it still has very strong potential to go up in price as well as increase earnings. I think really from two perspectives, we're seeing strong macro tailwinds. That's really in terms of where we're seeing vehicle sales go generally. We've got households that are now, their finances are in better shape. I mean, we saw just last month, house prices jumped again by 1.1%, and employment remains resilient. And as I said before, on the other side, we've got this growing EV market, and that adoption of EV, we see that's only going to increase, particularly with tax incentives like novated leases.
Russell, I will stay with you. How can Alpha complement a traditional equity allocation?
Alpha is really a great complement to a traditional equity portfolio. You've heard it's agnostic, it's unconstrained, which means it's not restricted by any particular market style or market direction. It generally adapts and performs in different market conditions. And if you take it from that point of view, this flexibility really makes it a strong complement to core equity holding. And what it does is gives investors the opportunity to capture what's happening in the market, regardless of where we are from a cycle perspective.
Gents, let's bring it home. I'm going to ask each of you for a final comment on long-short investing as we head into 2026 after what has been already a big 2025. Jamie, I'll come to you. What's your final thought?
Look, I'll keep it short. I think, Alpha aims to harvest outperformance in all market conditions.
Yeah, straight up and down. There you go. Russell, what about you?
I think I'm going to concentrate on the fees, which we haven't spoken about. So Alpha's base fee is very competitive. It's only 39 basis points, and that's about a third of what many of the active long-short managers charge in the market.
Yeah. Cam, bring us home.
For me, it's really the granularity in terms of the signals it's trying to harvest. Looking at not only headline metrics, but changes in those industry fundamentals as well.
Gentlemen, thank you so much for taking me and the audience through Alpha. Like I said at the top, I think it's a fantastic, innovative product and I'm intrigued by it. So thanks for shedding light on what is an interesting ETF.
Thank you for having us on.
If you enjoyed that conversation, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.